Did you know that in a recent survey, over half of crypto investors admitted they had no idea how to report their gains and losses on their taxes? If you've been dipping your toes into the world of crypto, you might be sitting on a tax time bomb without even realizing it. You're not alone in this. Many people jump into crypto, excited by the potential, but completely overlook the tax headache that can follow. It's a wild west out there, and the tax authorities are just now starting to catch up. So if you've ever bought, sold, traded, or even used crypto to buy a coffee, this video is for you. We're going to break down what you absolutely need to know to stay on the right side of the law and avoid any nasty surprises. Cryptocurrency has exploded in popularity over the last few years. It feels like everyone, from your cousin to your coworker, is talking about Bitcoin, Ethereum, or the latest meme coin. And it's easy to see why. The stories of massive gains are exciting and draw people in. But here's the part that often gets left out of those conversations. The tax man wants his cut. In the eyes of the IRS and many other tax agencies around the world, cryptocurrency isn't treated like regular currency. It's treated as property. This single distinction is the source of so much confusion, and it has huge implications for your taxes. Every time you sell, trade, or even spend your crypto, you're potentially creating a taxable event. It's not just about cashing out back to dollars. Swapping your Bitcoin for Ethereum? That's a taxable event. Buying a pizza with Dogecoin? That's also a taxable event. The complexity can be overwhelming, and unfortunately, ignorance isn't a defense when the tax bill comes due. Understanding these rules isn't just about being a responsible citizen, it's about protecting the profits you've worked so hard to earn. Let's debunk some of the biggest myths floating around about crypto taxes. The most common one I hear is, it's not a real gain until I convert it back to dollars. This is completely false. As I mentioned, tax agencies view crypto as property. Think of it like a stock. If you trade 10 shares of Apple for 10 shares of Google, you have to report the capital gain or loss on that trade. Crypto is exactly the same. When you trade one cryptocurrency for another, the tax authority sees it as you selling the first crypto and immediately buying the second one. You have to calculate the gain or loss on that sale in your local currency. Another huge misconception is that if you hold your crypto for less than a year, it's tax-free. Again, not true. In many countries, this just means your gains are taxed at a different rate. We have short-term capital gains for profits on assets held for a year or less, and long-term capital gains for assets held longer. Typically, short-term gains are taxed at your ordinary income tax rate, which is usually much higher than the preferential long-term capital gains rate. So, timing your sales can have a massive impact on your tax bill. And what about DeFi, NFTs, and staking rewards? The rules here can get even more complex. Receiving staking rewards or airdrops is generally considered income, taxed at its market value the moment you receive it. Minting or selling an NFT. That's a taxable event. Using crypto as collateral for a loan? You guessed it, there can be tax implications there too. The message is clear. Almost every transaction you make in the crypto space has a potential tax consequence. Let me tell you a story that really illustrates how serious this can be. There was a guy, let's call him John. Back in the early days, John got into crypto and made thousands of trades, turning a small initial investment into what he thought was a multi-million-dollar fortune on paper. He was trading like a pro, swapping one coin for another, chasing the next big thing. He felt like a genius, but he never cashed out a single dollar into his bank account. He assumed that as long as the money stayed in the crypto ecosystem, he didn't owe any taxes. The year ended, and he didn't report any of it. Then came the crash. The market turned, and the value of his portfolio plummeted. By the time he finally understood he had a tax problem, his paper millions had vanished. But here's the brutal part. The tax liability didn't vanish with it. He still owed taxes on all the profitable trades he had made during the bull run, calculated at the value at the time of each trade. He was left with a massive tax bill in the hundreds of thousands of dollars, but the crypto he held was now worth a fraction of that. He didn't have the funds to pay the bill. John's story is a nightmare scenario, but it's a real-world example of what can happen when you don't understand the rules. He faced penalties, interest, and years of financial struggle, all because he misunderstood how crypto taxes work. This isn't to scare you, but to show you that the stakes are incredibly high. So, how do you avoid a situation like John's? The key is proactive management and good record keeping. The first step is to track everything, every single transaction. That means the date you bought a crypto, how much you paid for it in your local currency, the date you sold or traded it, and the value you received. This is your cost basis, and it's essential for calculating your gains or losses. Doing this manually in a spreadsheet is possible if you only have a few transactions, but it becomes a nightmare very quickly if you're an active trader. This is where crypto tax software can be a lifesaver. Services like Coinly, CoinTracker, or Zenledger can connect to your exchanges and wallets via API, automatically pull in your transaction history, and generate the tax reports you need. They're not perfect, and you might have to manually fix some transactions, especially with DeFi, but they can save you hundreds of hours of work and a lot of headaches. Another strategy is tax loss harvesting. This involves selling some of your crypto assets at a loss to offset the capital gains you've realized from your profitable trades. This is a common strategy in the stock market, and it applies to crypto too. It can significantly reduce your overall tax bill, but it has to be done thoughtfully. And finally, the most important piece of advice: when in doubt, talk to a professional. A tax advisor or accountant who specializes in cryptocurrency can provide guidance tailored to your specific situation and help you navigate the complexities, ensuring you stay compliant and optimize your tax position. Their fee is often a small price to pay for peace of mind. To wrap this all up, let's recap the most important takeaways. First, cryptocurrency is treated as property, not currency, for tax purposes. Second, nearly every transaction, selling, trading, or spending, is a taxable event. Third, there's a difference between short-term and long-term capital gains, and the tax rates can vary significantly. Fourth, accurate and detailed record-keeping is not optional. It's absolutely essential. And finally, don't be afraid to use crypto tax software and consult with a qualified tax professional to help you get it right. Being a crypto investor is exciting, but being an informed crypto investor is powerful. Taking your tax responsibilities seriously protects your assets, prevents future financial disasters, and lets you continue investing with confidence. The crypto landscape is always changing, and the tax rules will continue to evolve with it. Staying educated is your best defense. What has been your biggest challenge or surprise when it comes to crypto taxes? Share your experiences in the comments below. Let's help each other learn. And if you found this video helpful, please give it a thumbs up, subscribe to the channel, and hit that notification bell. I have another video coming up on how to choose the right crypto exchange that you won't want to miss. Thanks for watching, and I'll see you in the next one.